Good morning and welcome to the March edition of the Balanced Perspective. I'm your host Mansoor Naka, and as usual we're joined by Iain Power of Truffle Asset Management. Good morning and welcome, Iain.
Morning, Mansoor, and morning to everyone joining the call.
Today's topic, value versus value traps. At the last Balanced Perspective, we spoke about pockets of value emerging, so I thought now would be a good time to actually make that distinction and be discerning, where we actually find that value. SA equities, which have been relatively cheap for some time and more recently has become even more cheap, offering very much optically at least good value compared to the global opportunity set. And I think now might be a good time to remind ourselves, obviously, that cheap investments does not always relate into good investments. Iain, as a fund manager, a large part of the process at Truffle is, of course, avoiding these losers, so to speak, rather than always trying to pick the winners. And this is key to generating long-term superior returns. So to kick off, Iain, at the last balance perspective, you reminded us that the portfolio, the balance fund, is of course tilted to getting those large global exposures rather than pure SA Inc. Just as a reminder, how do you see the local market currently, particularly when it comes to SA companies purely focused on the SA consumer, the SA economy?
Mansoor, I think that's right. I think the backdrop that you've sketched of optical value in SA assets is right. And the question is this true value, or is it a potential value trap? And there are certain instances where we do feel that there is good value in some of the SA assets, and where lots of these assets are pricing in quite a dark scenario in terms of potential earnings growth. But one must always remember that not all the companies are equal and not all the sectors are equal. And I think there are lots of sectors there, particularly some of the consumer discretionary sectors, where the competitive ability of these companies has been permanently impacted by the inability of the state to provide reliable services. And as a consequence, there's low or no growth in the economy, and then companies are facing higher costs to be able to stay in business. And I think when one takes a step back and looks at this, what it does is it means that the returns on invested capital that many of our businesses historically perhaps have generated might not be repeated in the past. So I think as a fundamentally based manager, one always needs to be careful of, just buying cheap assets for the sake of it and hoping that you'll see some sort of mean reversion in the profitability of the businesses which are under earning now, and hoping that they get back to some sort of mean returns. And typically that would be rewarded with a higher rating. And you really have to understand, is there still the ability for these companies to improve their earnings power back to where it used to be? And I think when we look at some of the sectors in SA, we've got caution around some of those consumer discretionary spaces, and hence we are preferring to take some of the exposures more focused on the global consumer discretionary names, where we can still see that ability of those businesses to earn and to generate earnings in line with their historical trends. And just a few examples there: businesses like Bidcorp, businesses like Anheuser, Richemont, for example, would be some of those consumer discretionary names where we think there is still the ability to generate returns like we've seen in the past. And I think avoiding the optically cheap value traps, and I think you only see that in time because hindsight is perfect science. But I think what we're seeing is a really difficult landscape evolve for some of our local discretionary consumer names. And my suspicion is into the winter, it probably gets harder. And you're going to see some really difficult trading environments for those businesses. And I think there's going to be big question marks around the ability of those businesses to get back to the returns that they have generated historically.
Thanks, Iain. That leads me to my next question. The team at Truffle has done really well to avoid some of the, I think, more obvious value traps that we're currently seeing out in the market. Just, EOH into Tonguat comes to mind. Are there sort of a common set of factors that you saw within these stocks? Just speak us through the process of how you go about actually avoiding the value traps.
Yeah, Mansur, I think, the thing is when we look at a business, typically we'll break it down and try and understand the different components of it. And first and foremost, we'll try and think about the moat or the competitive advantage that a business has. And this is really the reason why they are in business. And can we see a business case for this particular business, and is that moat defendable and sustainable? On top of that, one then needs to look at the capital structure, and the way the shareholders have funded those particular businesses. And, typically what one tends to see is businesses which generate high levels of reasonably highly predictable cash flows. Those type of businesses models can generate or at least carry a reasonable proportion of leverage or debt in terms of the way they are funded. And I think, those would be businesses like tobacco companies, beverage companies, some of the food producers. These are businesses which generate a lot of cash, and it's fairly reliable given that they're not really discretionary, and you can put a lot of leverage on the balance sheet. Now, some of those other names that you've mentioned, these were businesses where I think there was perhaps quite a lot of operating leverage in the business, or the ability to forecast the drivers or the profit drivers was low, and these businesses were left with high levels of leverage at a period where the operating cash flows, for whatever reason, came under a lot of pressure. And I think that's something that one always has to guard against. And at Truffle, we spend a lot of time looking at the ability of businesses to service their debt, because, in my 30 years of being in the market, I can tell you that businesses don't go under or bankrupt because they earn less money. They go bankrupt because they are unable to repay their debts when those debts come due, to the extent that they have no cash flows. And I think that is a critical element. So I think capital structure, and the way the businesses are financed is very important, and gives one a good sense of where the tail risks in certain businesses can be. And I think the cautions that we've learned in time is to where you've got businesses which have high operating leverage, you generally don't want to have a lot of financial leverage on top of those businesses as well. Because you can really find yourself in a position where equity holders get destroyed to the extent that suddenly cash flows dry up. So it's not just about understanding the moat and the competitive position and the ability of the business to generate above average returns, but it's also about understanding the way they finance those assets and how they finance the working capital in that business.
Iain, you mentioned you're 30 years in the market. As we know, active managers don't always get it right 100% of the time. And given the depth of experience at Truffle, where the portfolio managers, they've been through multiple cycles, how important is humility when it comes to your process?
Yeah, Mansur, I think it's a good point. And I think one of the big positives that you can bring to a portfolio and to your clients is to recognize when you've got your investment case wrong, because there's nothing worse than running these losers and stocks that then perpetually take value away, and where you sit in a position where the principal or the original amount that you've invested gets amortized down. Because, I'm sure you guys would have seen many of our presentations where we talk about the benefits of protecting capital and making sure that you don't lose money, and what that does to you then relative to your peers, and in terms of being able to generate the long-term real returns when you don't have to make up losses. And I think that's a big strength in Truffle, that when we think or we feel that we've got something wrong and we can see the evidence that we've got it wrong versus our base case, we will cut those positions. And we will move on. And I think, in asset management, one must be humble, because we recognize that whilst we have skill, it's not perfect skill. And, because it's not perfect skill, you are going to get some calls wrong, but you need to make sure that the ones that you get wrong don't destroy all the value that you add on many of the calls that you get right. And, we think, the one benefit that you can bring to the portfolio is recognize when you've got something wrong, and to understand the reasons why, and then to take action in the portfolio to redress that.
That, of course, ties in great with that agile investing process that, of course, that you have at Truffle, able to, take up or take down exposures within stocks or asset classes quite quickly. Iain, just to end
No,
off,
that's right.
Iain, just to end off, any potential red flags that you're seeing at the moment?
I'd probably say the biggest red flag at the moment, Mansour, is that you've got global central banks on the back of sustained high in core inflation, and particularly on the services side, are really guiding and talking towards higher rates for longer. And there seems to be quite a big dislocation in terms of markets, equity markets not buying into that. And interestingly, if we just look at the Fed Fund futures curve relative to where it was 2 weeks ago, you're starting to see the bond market price in, potentially higher rates for longer. But you're not seeing the same in the equity markets yet. So I think you've got, two sets of investors rowing their boats in different directions. And I think that gap is probably a cause for concern. And for as long as these inflation numbers continue to surprise us on the upside, I think the chances of a negative beta event, sometime later in this year continues to grow, as some of the equity investors are still pricing in some sort of immaculate inflation decline over the next 12, 18 months.
So absolutely the time to still remain very much cautious. Iain, we thank you so much for your time. Always a wealth of wisdom to listen to you. To our viewers, thank you for joining us. We'll see you next time. Bye-bye.